Hey everyone, and welcome to the new edition. We are yet to finalise the name, but I'm sure Kingy's going to come up with a great one for us. But today's topic is all around end of financial year. With not long left, what we want to do is sit around and just discuss around some of the end of financial year strategies and the things that us as financial advisors are chatting about with our clients, and some of the techniques that we really want to, deep dive with you guys. Now, obviously, due to time constraints, we're not going to be able to go through every single one of them, but we are going to go through some of the ones that may, affect different kind of generations in regards to some end of financial years, and then we'll talk about high level in regards to end of financial year. And this is to be an open discussion. So, on all of our social media platforms, you'll find us on all the major ones: Facebook, Instagram, LinkedIn. Please leave your comments, leave your posts, provide us with feedback. If you want to know more, we will get back to you. Now, just so you know, we are discussing some financial topics, strategies here, and none of this advice is personal. It is to be general advice only, please seek professional financial advice so that they can understand your personal circumstances before giving you financial advice. So once again, please don't go off and act on this by yourself. This is general advice only. So for the people that don't know us, my name's John Cachia. I'm the founder and CEO and financial planner at AFA Group Wealth. We've got a couple of the fellas here. I'll just go around the table quickly. Kingy, if you can just quickly introduce yourself, mate.
Yeah, so Ryan King from Three Kings Wealth Management, based up in Sydney, look after people nationally. We look after young, ambitious hustlers that want to get ahead while living the best life today, but planning for tomorrow at the same time.
Chris.
Yep, my name's Chris Carlin from Master Your Money Now. I'm the founder, financial planner, and mortgage broker here. We're based in Geelong, home of the Mighty Cats, but we service clients Australia-wide, primarily millennial nurses and teachers.
And James, over to you, mate.
Thanks, John. James Wrigley, financial advisor with a group called First Financial, based out of Melbourne, but clients are kind of across the country, a few of them overseas. Typically late 30s, mid 40s plus, kind of high income households through to pre-retirement, retirement space. So not so much the first home buyer market, but that kind of next age bracket up tends to be the space where most of my clients sit and beyond.
And just for everyone to know, you can see that we've pulled together all walks of life so that everyone can, probably help as many people as we can. We all work nationally with our clients. Everyone here utilizes Zoom. James doesn't usually work out of his backyard or me out of my child's room. But due to Melbourne lockdown currently, we've got to do what we've got to do. But once again, if you guys need any assistance, jump onto the group and one of the fellas will be able to help you, including myself, if we need to. So without any further ado, guys, let's jump into end of financial year. As we're recording this, it's the 31st of May. So it's pretty much, 30 days kind of till the end of financial year. And really, what's the main things we're discussing at the moment with our clients? And maybe, Chris, over to you. What's the main things you're chatting with at the moment?
Yeah, so as I was just saying before the call, like end of financial year is probably not the big driver in the millennial space. I know it's much bigger in the retiree space. I know James in particular will cover a lot of that information. It's just it is a mark for financial planners because as I'm sure all the guys here are all busy May, June, and then July goes a bit quieter again. The accountants pick up. But in saying that, there's certainly a few things that we'll be speaking about to ensure that all our millennial clients are on track. And the first one is definitely, the main one's probably the super contributions, making sure that what is your plan for super contributions? Have you maximized that? And whether that's contributions for your retirement or contributions under the First Home Super Saver scheme, where they've got the $15,000 cap for contributions for your first home, making sure you've maximized that for your plan. That's definitely one that is a very important topic. The other one as well is particularly those who are working from home at the moment, whether you do have taken advantage of end of financial year sales, and if there is any expenses that you do need to purchase and that are tax deductible in particular, whether you're an employee working from home or you're a small business owner, that's definitely something worth planning and looking into as well. And another one also is probably a bit more a passion of mine is if there is a charity or cause that is important to you, consider making a tax deductible deductible contribution to that charity of cause. If it helps some people, and less money for the government in a legal, ethical manner, then definitely something worth looking into. So there's a few little things there that we're definitely talking about with our millennial clients. But I guess the main thing I would note is if you haven't got a plan for this financial year to maximize the caps for this financial year, or you're probably too late. I know, John, you were saying that you're booked out for this financial year. I am as well. I'm sure Ryan and James are probably in similar situations as well. Now's probably not the time to plan for the 2021 financial year. Now's the time to plan for 21-22 and looking to maximize your wealth for that situation. So I think now's a great time, firstly, to look back at your wealth. And I would suggest that, unless you're in hospitality or airlines or something like that, if you haven't made wealth over the last 12 months, there's probably got to be a huge question mark on that. The share market's up 20% in the last 12 months. Property prices have gone through the roof. There is so much there that, to build wealth on. So reflect on this time. Use this time to reflect, well, am I further ahead financially than I was 12 months ago? And then what are my plans for the next 12 months? Now is a great time to really put in those plans in place and get you set up for financial year 2022.
That's some great topics, and I think even the donation one is probably things that people forget about. And it's probably a really good one. I think everyone on here donates in a quite considerable way, and it's something that's a passion of ours as well. And I think that you don't necessarily need to look at things that are going to make you wealthier, but if a passion of yours is to help someone else, well, the donations could be a good one. I think another one that we mentioned as well too previously in a chat that we had was around end of financial year sales. Now, guys, we're not advocating for people to go out and buy stuff, but remember, King is nodding, King is saying yes. But the gist of the story is as well too, is that if there is a plan to buy something, there is a lot of sales going on at the moment. So just to be aware of these sales and see if you can actually save money from these sales as well. Now, Kingy's itching because we haven't got him up on stage yet, but Kingy, millennial space, or just generally, what are you speaking about with your clients at the moment?
Yeah, so very similar to what Chris said. This year I tell all my guys, they come in and I need a quick tax return, mate. That ship sailed. If you're already just trying to get, a good tax return is not a tax strategy, right? It's not a tax strategy. It's a joke. So you need to make sure you're getting ready for next year. But what we are looking at is the big one for us would be like Chris said, with your concessional contributions into super and sort of analysing whether you're on track. And we don't believe that maximising your contributions at a young age is the only way or the best way. Just making sure you're on track, and at least if you've got spare money left over, that's a good way to reduce your taxable income, but also to make sure you're on track for your age 60 and onwards retirement goal as well. And then a big one is analysing whether you should be contributing your extra concessionals this year or banking them up over the next couple of years due to the catch-up rule, which, you're not going to be able to do that yourself really unless you really get numbers, but that's where an advisor can really add some value there as well. We do a lot of first home buyers. So first home super saver scheme is another one we'll be talking about. If you miss out this year, you're going to miss out on an entire year's worth of contributions, which if you want to maximise, is going to make a home purchase 12 months longer. So if they're within the next 3 to 5 years, that's something you're looking at. We definitely would consider that now, especially with the budget proposal increasing the amount we can do over the whole time, which will essentially add another year and a half to it. You want to make sure that if you want to maximise that, do it now. Otherwise, it's going to be 4 years before you're looking at purchasing home rather than 3. That's a consideration as well. We're massive. We work very closely with our accountant and the tax strategies around that. So we really make the introduction there, and we do a lot of small business owners as well. So making sure if you are a small business owner of any size, a small business owner of any size, even if you've got a side hustle, as a millennial, you've got a side hustle, making sure that this is a good time to analyze your structure for the year. Do you need to be registered with GST for next year? Do you need to set up structures in line with how well you did this year? Your growth can be bigger. What expense, do we need to look at the instant asset write-off? All those things this year as a business owner to make sure that it aligns with your personal goals, to make sure that you haven't just thrown a year down the drain and lost anything like that. And then just using the best thing about the end of financial year for our clients is it's a great trigger to analyze exactly what Chris said, how far you've come in a year, and set up the next year. Really sort of, some people can use, if you had a bad year, set it up as a clean slate. You can sort of go, all right, let's, the tax return is almost like that. Close the chapter, start income work, better start next year on a high and use that money towards something else. The last thing I'd probably say for our clients is we've had a lot of people come through who started in the investment market this year, whether it was shares or crypto, whatever it was. Making sure if you're new to that game, that you're making sure that you're understanding the tax implications if you've bought and sold or whatever you hold, whether you need to get rid of some losses, offset them against some gains this year, or really analyze your entire portfolio against what's happened. Because you're new to the game, there could be gains or losses that you're just missing out and you don't understand how to efficiently maximize stuff. You might be holding on to something that's falling, thinking that it might come back and it might not, and you could offset it against a gain somewhere else and be neutral and move forward into the new year with a fresh start. So little things like that, especially if you're in the investment game, you're new to it, make sure you're speaking to someone about it, because there's going to be stuff you don't know that you could be missing out. It costs you quite a bit of money if you compound that over the next few years.
Great topics there, especially around the investments and how many people are doing investments. I know pretty much everyone's invested at the moment, especially with cash accounts being where they are. And I think what we're finding as well too, which kind of complements that, is we're having much more active conversations with our clients because there's just so much more activity happening. So for people that necessarily think that they speak to their advisor once a year and they'll be done with it, definitely not in our case. And I know with the guys on here as well, there's just so much going on in people's lives. And one of the consequences of that is tax. As a tax financial advisor registered with the TPB, we need to make sure that we're looking at the tax implications. And then this is an area that I think is a little bit client misunderstanding. Your financial advisor can have a great impact on your tax situation. Yeah, great impact. And I think engaging with them on all facets of your life, if it be first home buyers, just generally in regards to lifestyle decisions and stuff like that, or in regards to investments and tax efficiently investing as well. Now, James, just a quick one in regards to you. Obviously, there was just some, I don't think it's official yet, but I just want to speak around the retiree space, or even the pre-retiree space as well too. There was some news that Scott Morrison announced in regards to the pensions, and just if we can speak around some of the super contributions discussions that you're probably having, and then just general around some of those, 40, 50, 60-year-olds in regards to what's going on at the end of financial year would be great.
Yeah, so if we could continue on the topic of super that we've been talking about, making contributions and the like, often a lot of my clients are in that kind of early to mid 40s age bracket plus. Quite typically, if they're a couple and having children, and not all of them do, but if they are, often they're both back at work, and you're starting to get to this point where there's this big discrepancy between the person that's continued in the workforce all of that time versus the person that's taken some time out to raise children. So we, looking at the super contributions, we then also overlay that with splitting. So if you've got one person that's earning this big income and their super balance is just going to keep going and going and going, ultimately going to end up with pension cap problems, which I'll touch on in a second. So we start to overlay a strategy of splitting contributions from this higher income earner to the lower income earner to try and even out those balances so that they're roughly both growing at the same rate. Better have $1 million in this account and $1 million in that account than $2 million in one and nothing in the other once you get to retirement. And that's something that you can't fix very quickly. And so you can't wait until you're 60 or 65 to try and deal with that, because then you're stuck with other contribution cap problems. So those higher income families, that's a strategy that we start to implement in the 40s to try and even out those balances.
And James, sorry to say, do you think that that's a discussion, like as in, do you think that people should start thinking about that potentially when they're starting to have children? Like how early do you think these people should maybe start just to think about it?
Look, I think it's useful to be aware of.
Yeah.
If you're in your late 20s or 30s or something and having children, you've got bigger things to worry about then.
Yep.
It's houses and childcare and return to work and all the rest of it. It's not something that we kind of raise it as an issue with clients, but it's not something we actually start to do anything about until people have settled back into the workforce, if that's what they're actually going to do. And And so then we can say, look, your child raising years are probably behind you. They're in later childcare or back in primary school, and off you go. And then we start to look at, okay, well, what does the future then look like? Because it's at that time that there's often also a little bit of surplus cash flow around. So if the person sure is now into the force part-time, full-time, generally most households have managed to get through those years with just one person working. You've gotten through fine up until then. So let's just start to make some smart decisions with the money that's now available when that second person does go back to work, if they do decide to go back to work. So we tend to not do it until late 30s, 40s, that kind of age bracket. Just get through those years and wait and see where career takes you and income takes you, and if it's available. Then I guess if you fast forward through to that pre-retirement space or that retirement space, what you were alluding to earlier about some announcements late last week, there was some reduction in the amount of money that people have to take from their pension accounts each year to satisfy pension requirements. That was halved the financial year before. So that was halved last financial year. It's continued on for this one. And we're expecting that to be abolished come the end of this year because pension balances have increased so much. As you're saying before, markets are up 20-odd%, so pension balances have recovered similar amounts. But nevertheless, there were some announcements from the Prime Minister on Friday to say that they're going to look to extend that concession, which is strategy for a lot of our kind of retiree clients. Is we have them running pension accounts within their superannuation funds, whether it's a self-managed fund or wherever else, but within their super funds, and taking advantage of these reduced minimum pension drawdowns, even if they don't need the money. So we run a pension account for the full year. They have to take a much smaller withdrawal than what they used to have to. In a lot of cases, they can contribute that money back into superannuation as well, and we can kind of artificially create this whole transition to retirement strategy that a lot of people were advocating for many years ago, where all you had to do back then was you had to just reach this thing called preservation age, and back then it was age 55. So that's changing. It's going through to age 60 now, but all you had to do was reach a certain age. You could start to draw a pension from your accumulated super benefits. All of a sudden, you're not paying any tax then on that super balance, and people would take that money out and put it back in, just recycle that money around. You now can't really do that strategy unless you're retired. But so we can overlay that strategy if they can satisfy a retirement condition, and there's varying types of those. If you can satisfy a retirement condition, we can artificially make one of these transition to retirement pensions of sorts. They're taking money out, putting it back in again, realizing assets if they were going to. Like I've got a few clients that have own property in their super funds, as we were talking about before, that the property market's gone through the roof. Holding one big lumpy property is probably not a great strategy for retirement. You've just got the rent coming in there, and it's maybe 2 or 3% if you're lucky. Argument that I put to a lot of clients is to say you'd be better off on the age pension than owning $1 million investment property. If that was all your retirement savings, you'd be better off not having it. You would earn more from the age pension. It's guaranteed by the government, and it's indexed every 6 months. You don't have to mess around with tenants and all that jazz.
They're not asking you to fix the aircon or do the door handle or whatever.
So the argument that I put to a lot of clients is to say if that's all you've got, you're probably better off not having it. And so, timing around when do you sell that, because you've got capital gains tax problems. So if we can, create these tax-free environments through some of the rules that are allowed, well, then it's a strategy that we implement for clients. So it's looking like that's going to be extended. So our clients will continue to draw these pensions for the next year, have the tax-free earnings, even though they may not necessarily need the money, but it's a worthwhile exercise for them.
Well, for everyone watching or listening, it's probably you've seen from around the grounds, there's a lot of things that you should be discussing with your financial advisor. Now, a lot of these plans take years to kind of come to fruition. Some take months, some take weeks, some take days. Yeah. But speaking to your financial advisor around this is very important. Now, fellas, I just want to kind of hone down on 2 topics. Yeah. One is the first home super saver scheme. Yeah. And the other one is around super contributions and like when. When do you actually start with the contributions? Like when you're looking at a client situation, how young is too young? Or how much do they need? Like this is a great topic that I think that I've seen 25-year-olds, salary sacrificing before they come in and yet don't have a house and want a home deposit, and then you've got people walking into their 60s on 200K and haven't even looked at it. Like let's start with super contributions because we've been talking about it, and then we'll get into the first home super saver scheme. But guys, when do you start looking at this stuff? And when is enough? So yeah, Chris, over to you, mate.
I'm probably going to say as soon as you're working full time.
Okay.
Is when I would start looking at it. And if you've got a full-time job, and I mean, start a grad role earning 50 grand a year or a trade earning 50 grand a year, then you could definitely consider making additional contributions to super. The big question though is how much.
Yeah.
And I think that's where it's a little bit different because I personally quote the rule of 30, which if you put $30 a week into a high growth super account for 30 years, earning 10% per annum, you're going to have an extra $300,000 for retirement. Which is pretty good on $30 a week. And like I said, if you're earning 50 grand a year as a grad, that's a great time to start. So, so those little things that you do in your 20s and 30s that don't sound like much make a huge difference over the next, in comparison to doing like $1,000 a fortnight at age 55. Doing that little things at the start makes much more of a difference. So
I know that we look at it quite young, but when we go through the exercise with most of our younger clients, and when I'm talking about younger clients, I'm talking early 20s, is the goals usually dictate the strategy, let's be honest. And it's most of them say, if I can retire early, I can. And so when we look at the buckets, which I'm sure most people do in regards to short-term, medium-term, long-term buckets, and superannuation most likely being the long-term bucket because it's the most tax efficient.
Yes.
It does lock away a lot of this money for these individuals who are starting quite early. And if we do our job properly, there's a consideration to say that a lot of this money should be allocated outside of super. Yeah. And so what I mean by that is, if you look at a young person saying they're 25, if they've got a proper savings plan, proper investment plan, by their 50s, they're looking pretty good. Yeah. If they lock too much away in super, they're just not touching it. So it also becomes, I think, a balance for me anyway, in regards to that percentage. If they could save $30 or they could save $50, how much of that is going into the long-term bucket that they're not going to touch until they're at least 60, and then how much are they going to be wanting to touch beforehand? And I know you guys are doing that as well, but it's timing how much, and then just understanding that, yes, you're getting the tax efficiency of superannuation, but you're giving up something in return, and that's being not able to touch it for a long time if you need that income prior.
Hear what you're saying, John. I guess a couple of things I would say on that. First and foremost, I think you've got to crawl before you can run. And most people, not all, but a lot of people that I see, that are focusing on building wealth in their personal name do not have their super sorted. And superannuation, I think, needs to be sorted before you look at investing in your personal name. Because super is going to help you retire at 60, and then the investments in the personal name are going to retire at 50. And if you've got a plan to invest in your personal name and not consider super, that's not a plan. I picture someone like investing in crypto or something like that. Like you need to have your foundationals right. And again, it's a bit like trying to invest without having a good cash flow budgeting and carrying a lot of personal debt. It just doesn't work. The other thing I would say is you mentioned this before when it comes to the buckets. When we're investing your personal name, most people think that you need to invest in your personal name to have enough money for the rest of your life. And that's not the case. All you need is enough money to retire until age 60 when your super comes in. So if you've got a plan to retire at 50, and I want to help all my millennials to be in a position to retire at 50, they don't need 40, 50 years of assets or income in their personal name to invest at age 50. They only need 10 years. They just need enough funds in their personal name to get from 50 to 60, and then the assets in the super kick in to fund them from 60 to the rest of their life. So, and as you said, superannuation remains the most tax effective way to invest. So, yeah, I do agree. Yes, you can put too much money into your super, which can have a detrimental impact on other goals, like buying the first home or investing in your personal name. But if you've got plans to retire at 50, superannuation remains a key component of being able to do that.
Kingy, you were going to say something, mate?
Yeah, I said legally it's the best.
Yeah, true.
We
should have stuck him on mute again.
I do want to jump in. So yeah. I agree 100%. We change out. We fully done a program around changing our millennial way, because investing in your own name is so egotistical. Like half the reason people do is because it seems cool, you know. And the big education we do is you stop looking at your superannuation as the only way to retire and look at it as your worst case scenario, right? Like set it up as your worst case scenario. It's the easiest way to do so. Why would you try and set up a worst case scenario at 60 million? And then exactly what Chris said, if you want to retire earlier, and we don't really talk about retirement a lot, we talk about financial independence more, and our best retirement strategy is find something you love doing and monetize it and just keep doing it. But when we talk about having that independence, is we then from 50 or 45 or 55, whatever it is, it just becomes a gap funding. That's what you're doing. And when people see how easy it is to retire at 50 from 30 years old doing that stuff, it really changes the game on what they think there. And then that's your foundational point, and then build from there. You know, it doesn't need to be cool, sexy, and over the top.
James, any comments around this stuff from yourself, mate?
Yeah, look, something I've done myself personally, and I got a few clients doing it, is this idea. I saw it somewhere years ago, and it's just stuck with me ever since. Is this idea of saving more tomorrow? So if someone's sitting in front of you, you know, they're often living a particular lifestyle, a mortgage or whatever, and most people are spending everything that comes in. Very few have a whole lot left over. But if you sit with them and say, look, that next time you get a pay rise, can we do something with that then? And so this idea of saving more tomorrow is so that the next time you get a pay rise, put $50 a fortnight or $50 a month into your super, so that you're doing something constructive with some of the money. You're still seeing a little bit more coming into your pay packet. I've done that myself for a few years now, you know, as I've received pay rises over the years, and I'm at a point now where I'm contributing right up to my concessional cap, and I have done for the last couple of years. So I'll be 37 this year, and I'm at a point, as I said, where I'm contributing up to my cap, and I haven't noticed it. Every time I've got a pay rise or a promotion or something in my job, sure, you get paid a little bit more. There's a little bit more comes into my monthly pay, but at the same time, I've done something constructive with saving a little bit for tomorrow. So that's just, you know, it's easier to get that commitment from people to say, can you do something about saving more tomorrow? The next time you get a pay rise, don't just blow it on something. Let's do something constructive. Increase your contributions by $50 a month, $100 a month, whatever it is. Before you know it, you're adding a few $100s a month extra in. You're earning a decent wage over time as you get older, and you get promotions in your career and so forth. And before you know it, you're at the cap. So it's easier. It's actually a whole lot easier than what you think. But if you sit down, you know, someone that's earning $100,000 today and say, you know, sacrifice 15 grand a year, they're going to, where the hell's that money going to come from? But something you can build up to over time. And that's what a strategy that we've got clients doing. So they're not maxing out earlier on, but as they're getting older, as they're earning more, as those tax advantages become more powerful for them, they're slowly getting towards that cap. And by the time they're in their mid 40s, earning a couple of $100,000 a year, most clients are maxing out their contributions by then.
Great. That's great.
What's really cool is this little dynamic we've got here for people watching to understand, is that there's a million ways to skin a cat, right?
Exactly.
Not always about, people always coming, what's the best way to do this? And I always say, it's not the best way to do anything. It's what's best for you and what you're doing. What James is saying, you know, you got some people are process driven. Some people want to be like, okay, like what James saying, you know, I can't think about the outcome, just what I need to do. Where other people go, I'm not going to do the process and I understand the outcome, you know, and that's what we sort of do. Our process is very analytical in the way of, here's the outcome, let's build backwards. But we do have clients that we've tried that with, it doesn't work with, and you got to go, you know what, forget that. Hey, just exactly what James said, spend less tomorrow or save money tomorrow, and doing that kind of stuff. And I think it's really important for people to understand that that's part of the process you got to look at. It's not about the best case scenarios, what works for you, because if you have the cure to cancer but no one uses it, doesn't cure jack shit, right? So you need to make sure the execution is the only thing that matters. And there's 10,000 different ways the knowledge can be applied, but applying to the way that suits you is what's important. You've got to find that.
And I think to even add further to that, I think the common trait with all of us on this is that it's all about the goal in the individual's life. Yeah. And everyone's goal is different. Yeah. Some people want to work the rest of their life. Some people want to live off $300,000 a year. Some people want to live off $30,000 a year. And all of the strategies impact the individual differently. And so each individual advisor doing their job will look at the goal and the strategy then that's suitable towards the goal. And I think that's the key for the viewers and the listeners as well. Now, we've been on this for a little bit, and I just want to wrap up on one other key area. It's in regards to the first home super saver scheme. And to Chris and Kingy, do you want to just discuss a few things? Is probably when's the time to start thinking about that particular strategy? The timing around that strategy, and then one that I've heard, what happens if I don't buy the house? So over to you, Chris, maybe.
Okay, so first home super saver scheme, for those who are not aware, so your employer is currently putting in 9.5% of your salary into super. It will go to 10% as of 1 July. You cannot use that money for your first home. However, if you were to put additional contributions to your super account, you can withdraw that money again for your first home. And if you're working full time, you can contribute up to $15,000 per financial year, up to a current lifetime cap of $30,000. Withdraw that money again and save $4,500 in tax. Now, the budget did propose that the lifetime cap go up to $50,000, which means a savings of $7,500 in tax. But that hasn't been gone through legislation and will only kick in as of the 1st of July 2022. When to start thinking about it? I would say start thinking about it straight away, because you can either do this via salary sacrifice or making fortnightly contributions through your pay, or monthly or weekly, depends how you get paid, or you can do it as a lump sum contribution. So we've got clients who are going to be putting in 15 grand in June, 15 grand in July. They've utilized the caps over 2 financial years and then withdraw the money again and save $4,500 in tax in a period of 2 months. And if you're buying as part of a couple, then you both have access to that scheme, which means the total tax saving currently is $9,000. So it depends on your situation. It depends on your when you want to buy the property. That's really important. And I don't think you can have this discussion without also mentioning the first home loan deposit scheme, which is if you get, which means you only need a 5%. If you get into the scheme and are eligible for the scheme, you only need a 5% deposit for your first home without paying lender's mortgage insurance. So, so to get into that scheme is quite tricky, and that's probably a whole nother podcast for another day. But yeah, if you're looking to buy a first home for say $600,000 in Melbourne, rather than need a 20% deposit, which is 120 grand, you only need a 5% deposit, which is 30,000 plus costs. So definitely becomes very achievable there. So,
so Chris, I start thinking about it straight away when obviously I'm thinking to buy my first home. Yeah. There's obviously timing things, which is, you can either kind of put lump sums potentially before the end of the financial year and at the start. And so for that client that goes in at the end and then at the start, that financial year, can they then go pull out that money? So like, is there restrictions, or do they have to have a contract? Like, how does it work in regards to, I've put my $30,000 in.
Yep.
I think I'm going to go bid at that house. Can I pull my money out?
So the key to this scheme is and the wording is a little bit grey, but I would always say, and withdraw your money before you sign the contract.
Okay.
So that for me is the key. There is a 14-day grace period, but I would say withdraw your money out before buying a property.
You have to at least apply for release prior to
Yes.
sale. And
Yeah, correct. So,
Mhm.
and then once you withdraw the money, you've got 12 months to buy your first home. You can apply for extensions, which we did for a couple of clients due COVID under special circumstances. But ideally, yeah, it's a 12-month window that you've got to buy your first home. So I would
obviously 13 months rolls up, yeah.
Yep.
And I missed out on that property because that property developer outbidded me, yeah.
Yep.
What happens?
So like I said, you either apply for the extension, and like I said, historically through COVID, the ATO are actually pretty good getting the extensions. I'm not sure what it'll be looking like going forward, but so you can apply for the extension, or otherwise you've got to put the money back into super. But I'll face some penalty tax. So probably the one that I would be most mindful of. I'm not concerned if you don't buy the first home. Well, I am concerned about buying the first time within 12 months, sorry.
Yeah.
What I'm more concerned about is if you go and buy an investment property.
Yeah, okay.
Because that means, yes, you've done something that the ATO does not like, and then penalty tax will be applicable. So I would suggest, like I said, you've got a 12-month window. There does require some planning and some commitment to buy that property, especially if we're doing a pre-approval as well, which I would always recommend if you're looking to buy your first home to know your borrowing capacity. But yeah, if you say, look, I don't think I'm going to buy in the next 12 months, I'm just not in the right space for whatever reason, just leave the money in your super. It's not going to go anywhere. And you can withdraw it in 12 months later and start the 12-month clock from there.
And I think this goes into saying as well too, guys, even in regards to the way that these contributions are invested is also very important. If you're looking at short-term timeframes, you should also be looking at how the contributions are actually invested as well. And this is why it's important 100%. To speak to your financial advisor, because there's things like timing risk, which you want to make sure that you're looking towards and looking at as well. The other quick one just on that, and we will wrap up, is just another one for the listeners and viewers on there, is in regards to, I put my contribution in this financial year for 15 grand, for example, and then I put it in next financial year, and then I don't do any. And, I'm looking. How many years can I go back and then grab those contributions and use them? Is it, 12 months, up to 3 years, up to 5 years? How far back can these first home buyers go?
There's currently no limit. As long as the contributions are after 1 July 2019 in terms of additional contributions, and then you're fine. So if you did contributions back in 2015, you won't be able to access them.
Yep.
But if it's within the last 1 or 2 years, I'm pretty sure it's 1 July 2019.
Yep.
Then yeah, you're able to access them. So if you didn't buy the house until 2030 and just left the money in there, it continues to be in there. It earns interest at a higher rate. Then you're all pretty good. And I get the question, what happens if the rules change? And that is a possibility. I would say in that situation that arrangements would be grandfathered, which means you'd still get the benefits. That's what happened with the previous first home bank account scheme that Kevin Rudd brought in. That got closed down, but anyone that was in that scheme got the benefits. So yeah, if there is a rule change, which in the next 10 years, I'll probably guarantee there will be a rule change, then there should be some grandfathering or some sort of relief, so you're not worse off as a result.
Perfect. Kingy, any other comments in regards to that? Or I'm sure from my end, Chris nailed that pretty well, but anything you want to add?
No, Chris nailed it. The only thing I'd say is, like, we've had 3 clients this year. Sort of, you do have to plan it. You can't. We've had 3 clients. 2 of them came to us and didn't think they could buy a home, and they were ready to buy a home straight away once we did some basic planning. And we had another one who got inheritance, and they found houses really quick, got pre-approval, and it just wasn't enough time to. And in all seriousness, it wasn't worth the 7.5 grand or 8 grand benefit to miss out on a house just to get that later on. So that was fine, but you do have to plan it. It isn't a 2-day thing. You've got to plan it a few months in advance and really have a structure around it to make sure that you're not under time pressures and you don't miss out.
Yep. All right. Well, to all the viewers and listeners, thank you for joining on here. We are going to try and do this on at least a monthly basis. What the kind of general thing from all of us here is that end of financial year is kind of a mad rush into the end of financial year, but it's mainly for the clients that we're already engaging with, because we're implementing and amending and changing all of their existing structures or their strategies and providing with advice. For the people that are not engaged with a financial advisor or maybe doing some of this themselves, there are some things that to be looking at, obviously, for, there is the deductibility of donations and stuff that we discussed, and obviously some of the other deductible things, but as well too, obviously superannuation is a big part of people's wealth creation, but it also has some timing stuff in regards to the end of financial year. Also around the first home buyer super saver scheme, so to looking at that and if that's applicable to you. But, hopefully you guys have enjoyed it. If you guys have any feedback or any comments, please leave it on our socials or contact us directly, and we'll be happy to have a chat. So, fellas, thank you very much for joining on here as well. James, hopefully you get back inside, mate, into the nice warmth. Kingy's got his freedom at the moment.
Hopefully.
And that's it. Kingy's got his freedom up in Sydney. So, and Chris, have a lovely one, mate.
Thanks, John. Thanks for organising. Thanks,
guys.
Kingy. Thanks,
Great to
everyone.
see you all.
Thanks, James.
See you next time.
See ya.